Well, the markets still don't care about Venezuela. That much seems clear, but they do still like the precious metals. What to make of all of this and where we're going from here is what we're going to try to figure out on Macro Money here. I'm Ilya Spivak, head of global macro at tastylive. And what we're going to do is, of course, as we usually do, take a look at the price action that we've just seen over the past 24 hours and take a look at what's coming next and see if we can't contextualize what all of this now means with the benefit of a little bit of the dust settling after the weekend's explosive headlines. So here is what we're looking at, another modest day higher for stocks. They don't ultimately make new highs, and that's perhaps interesting in and of itself, but nevertheless, a perky day here for the S&P and for NASDAQ. Still, though, those October highs that we have in mind here, they are holding in all of these indexes. They're holding in the S&P. They're holding in NASDAQ even more overtly. In fact, the NASDAQ hasn't even come back to test its December highs. The Russell, which we don't have on the table here, which has been a little bit more perky, managed to get north of those late December highs, but is still very much contained below its peak from mid-December and still in a choppy range. So the markets are higher, but they're not exactly showing tremendous follow-through or conviction. Yields are a touch higher. And again, we're still sort of in this oscillation mode in the bond markets. Yesterday was a bit of a wiggle higher in the bonds and lower in the yields. Today, it's a little bit of a wiggle the other way, but we're still very much within the ranges that we've been carving out across the yield curve since the beginning of December. Very narrow ranges at the long end, the 10-year, the 30-year. And for the front end of the curve, we really haven't gone anywhere since that late November range establishing rally. Only a few days of gains there, but still relatively flat. And we take a little bit of a further look back, we haven't really gone anywhere on the front end since mid-September. So things relatively even here, but for the usual suspects around the news flow here, crude oil down, yesterday's tepid bounce overturned, down 2.35%. Gold up again, because apparently that's all it knows how to do these days, up 1 and just about 0.2% almost. The dollar a little bit stronger across the board. Bitcoin back down off its range high that was retested yesterday and getting pushed back into, or at least towards the middle of its range and into consolidation mode. So not really very exciting for it. But if we look at what seems to be behind this kind of standstill-ish price action, but for gold and oil, we find that if it was geopolitics that you were looking for, it isn't on the board. And in fact, looking at the relevant assets here, there's just no indication that the market thinks that this Venezuela rate is anything to worry about. Take a look here. This is the iShares MSCI benchmarked Latin America ETF. This is the top 40 Latin American stocks here. And what you see is over the past 2 trading days, that of course coincides with the response to this Maduro capture. That's this right here. Not exactly pessimistic. The same thing here for Brazil, a country that the president has actually expressed some direct annoyance with. not really that much worse. Again, the past 2 days looking pretty chipper here. Another country that the president has directly name checked, and as a matter of fact, even just most recently in his conversation around Venezuela, this is the Colombia ETF, and here again, nothing. 2 days of upside. In fact, we don't have this chart here, but the bourse in Caracas, so Venezuela's own stock exchange, is having an explosive day, up 62%. Now, of course, expecting any kind of liquidity from the Caracas bourse is probably asking too much. But as we look at these more liquid instruments, Colombia, Brazil, a regional index, it's very clear that the markets are just not perturbed by this. Moreover, here's crude oil, as though our table were not enough. We can see here, this is that narrow range in crude oil. This was yesterday's modest rally. Note the long wick on that rally, which just shows you very clearly that the market initially sold off on the Venezuelan news and really only bounced into its range top after. Today, even those gains go away. So this does not look like whatever's happening geopolitically is having any sort of meaningful impact on what's going on. So what is it that the markets are waiting for? Well, the first batch of real weighty U.S. economic data is going to hit us in the next 24 hours by way of the service sector activity index from the Institute of Supply Management. And as ever, this is done in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Service sector part of these surveys, of course, is the most impactful because services is by far larger than manufacturing in its share of the U.S. economy, of employment, of contribution to economic growth, et cetera, et cetera. And so this is clearly the big story. If the Fed is going to get some extra motivation to cut rates, or in fact is going to have some extra motivation to sit on its hands, this is an impactful number and a decent approximation for real-time GDP estimates. So this should be interesting. We got the manufacturing numbers earlier in the week. They were a touch worse than expected, 47.9 versus 48.3 expected. So the manufacturing sector shrank as expected, but at a slightly faster rate. The expectation for the service sector is that it'll cool a little bit down to 52 on the index, but obviously that reading above 50 is telling you growth remains intact. And if anything, this period here, November, December, and October, right through the government shutdown, give you a sense that the economy is still holding at a relatively even keel. Now, if we did the math here for a composite index that takes in both services and manufacturing, and we did kind of back of the envelope math, scaling it, saying, okay, about 30% weight for manufacturing, about 70% weight for services, because of the disconnect for how much one matters relative to the other for the economy, given its relative size, then if we get numbers in line with expectations, then we'd have the slowest overall growth or activity growth in the U.S. in 3 months. Would it be a number that was sort of terribly out of step with the trend average? Not terribly so. In fact, the average for the 11 months of 2025 before we arrive at December is about 50.7, 50.8. And the December numbers scaled, as we've just described, would land almost exactly right there. So it would be almost perfectly on trend, and therefore not really a meaningful impetus for the Fed to do anything slower or anything faster. If we look into the manufacturing numbers that we've already seen, we can see, in fact, 4 consecutive months of deterioration. And what's interesting there is the kind of key inputs for the Fed largely support their argument. Inflation seems to be evening out. Meanwhile, employment remains in contraction mode. So the Fed's argument of we need to focus on the jobs market because inflation is not the pressing issue that we thought earlier in the year because it has meaningfully cooled off, that basically gets reinforcement here. But nevertheless, if we look at the crux of what the markets care about, they've got 56 basis points on the menu in rate cut. This is backed out from Fed funds futures for this year, and essentially nothing for next year, giving us a pair of rate cuts over a 2-year period, but those rate cuts centered on 2026. If we look at what the Fed was estimating in both September and December, it is in fact 2 rate cuts over 2 years, but the Fed's looking at 1 cut this year, 1 cut next. And what the markets want is greater urgency. And we can see that in the way that Fed policy expectations have been reacting relative to stock markets. What we're looking at here is this sort of standstill in stock markets. We've essentially been confined inside this narrow range. We tried to get back above it. It hasn't really stuck. We tried to get underneath it. That hasn't really stuck. But what this consolidation lines up with is this setup here on Fed policy expectations. So after this large dovish adjustment, we've basically gone sideways as of about October, maybe a little bit earlier. And as that has happened, and as we've sort of come off the most dovish extremes in this range, stocks have struggled. So what is it that they want to see? Why is it that they want this easing? Well, for one thing, we know they're comfortable with not getting the easing in January. Doesn't seem like anything is falling apart, and the markets look quite convinced that we are not going to get a policy change on the 28th when the Fed is going to issue its next announcement. Almost 82% chance that there's no change here. So clearly the markets are unbothered, at least there. But if we look at what the matrix here suggests, we've got 1 rate cut in July and 1 rate cut in April. At least that's the way the markets have it laid out. So looking at this over here, we already have a situation where it's over 50% chance that you get a cut, less than 50% chance that you stay put. Similar story here, over 50% chance that you stay put in March, but then that declines to 42%, and the cumulative alternative is over 50. So at least 1 cut here, at least 1 cut here. That's already in the market. And of course, already clashing with what the Fed is saying. Now, the internals of these ISM numbers generally line up with what the Fed argument is. Employment in contraction mode here. Again, here's 50. So both services and manufacturing employment, both on the wrong side of that midline, both in contraction mode. So beckoning the Fed to do more and for the reasons they've been doing it. The inflation side, again, generally in line with what the Fed is signaling as well. We've seen moderation in inflation now for both services and for manufacturing. So again, echoing this idea that there's not really anything for the Fed to worry about here at the moment. So why wouldn't they just cut? Well, economic activity doesn't seem to warrant it. The third quarter GDP numbers that we saw ended up looking relatively solid. In fact, this rebound in the consumption component, the largest contributor to GDP by far, makes for a fairly solid third quarter, much stronger than these shenanigans in the first quarter and the second, with all these back and forth swings in imports and in private inventories around first front-running the tariffs, then spending down the inventories that got accumulated as part of that front-running, weak consumption. This looks like a much healthier quarter. Strong consumption, de-emphasized everything else. A little bit of a pop in exports. All of that looks relatively encouraging. Now, of course, we know that in the fourth quarter, we had a government shutdown that impacts this calculus. But looking at the last 3 months of 2025 here on data that we do have available, this is the S&P Global PMI numbers. They were, in fact, just updated with final readings today. And what we see here is a situation where you certainly have a slowdown in the last 3 months of the year, but what you don't have is anything looking catastrophic. So if you sort of run through where the middle of this chart is, for what is sort of normal growth after this post-COVID catch-up surge right here and the subsequent kind of correction for this outsized jump, going from right around the beginning of 2023 and on, here's your range for growth. Notably, it's all in positive territory, and the middle of the range is just about here. So the shutdown seems not to have derailed the U.S. economy in a meaningful way, but just pushed it off these headier growth levels and towards something more like the post-COVID normal. So again, interesting question here. Why is it that the markets want these cuts? Why isn't the Fed right in saying, you know what? We signaled intent. You're going to get a cut. We told you you'd get at least one. Now, the economy is doing fine. Why the hair on fire? Why can't we get sentiment to feel better, even though the Fed is not committing to giving the markets as much easing as they want? And why do they want that much easing to begin with? Well, we've postulated here that the problem is uncertainty. And the desire for rate cuts reflects essentially a push for the markets to become insulated in the Kevlar of cheap money, as all of the various uncertainties wash over investors and they go, you know what? We might get a bunch of stuff wrong here because the world is really volatile. But at least if there's cheap money, then we can borrow back cheaply to go again. But clearly, if the Fed doesn't comply, then that calculus doesn't quite sound as warm and fuzzy as it would if, in fact, the rate cuts came. So, looking at this trade policy uncertainty index, we can see it has no doubt come down from the April spike last year around Liberation Day, but the amount of fuzz and chop around these averages is, of course, notable here relative to how tightly wound this was around the average, even during COVID and its wake, as global supply chains were being mended. So this is obviously something different, and that it kicks off in 2025 seems likewise obviously linked to the tariffs, even though the worst seems to have been passed in terms of a spike in uncertainty. The level of just day-to-day volatility around what people perceive here is obviously, different league than we've seen in a very, very long time. So, with that in mind, are we seeing this actually impact global commerce? Well, yes. Global trade volumes declined in 2025. That was the first decline since this very narrow kind of blip of a negative reading in 2023. But other than that, the preceding decline was COVID. And then the only comparable decline was back in the 08-09 financial crisis. So global trade has meaningfully dropped off with all of this uncertainty. Now, the biggest issue for sentiment, of course, is that stock markets are overwhelmingly reliant on the AI story and buoyant tech stocks. We can see that here in the relative performance of that sector, information technology here, relative to all the others. But the risk to this sector from deglobalization and from trade policy uncertainty is very much an acute one, considering just how globally distributed the AI supply chain is. 26% is in Asia, 24% is in Europe. Of course, most of it is in the US because all the models are for the most part in the US, but between lithography in Europe and all manner of high-end assembly and chip making in Asia, there's really not a resilient supply chain here if global trade links remain volatile or rupture. And this is the bedrock upon which stock market valuations stand. Perhaps it is not surprising that if we look at the amount of the benchmark 10-year treasury yield that's made up by term premium, which is just compensation for duration, that is to say, compensation for risk of holding over a longer period of time, we're looking at the highest reading since back in 2014, when the Fed first started raising rates after the 08 financial crisis. So this is a meaningful amount of duration risk in long-term U.S. bonds, speaking to a market that's jittery and uncertain and that wants to be paid because it fears what may be downwind. Notably, the inflation component is steady. So it's not like the markets perceive economic strength as likely to be inflationary. In fact, yields themselves and real yields, excluding inflation expectations, are fairly steady. But this right here speaks to significant concern and suggests that this, in fact, may be what the markets are most in tune with. Not geopolitical risk as such, but the need for cheap money to prevent against geopolitical and other risks, all manner of them, seemingly. And so if we get ISM numbers here that don't really give us a strong impetus for the Fed to go more aggressively, if these numbers are, as U.S. numbers have been, relatively steady, pointing to an economy that's gone through the shutdown and held up reasonably well, that might actually end up looking like a negative sentiment read for markets, which want to get weak enough data that the Fed might be inspired to move sooner and with greater emphasis, but not so weak that there is some sort of a recession scare. As far as positioning is concerned, then I'm still short risk here, expecting that the markets are running the risk of disappointment with all of this data. And I've got this on through put verticals in IBIT, so Bitcoin, IWM, Russell, the Qs, NASDAQ, SPY, S&P. So I'm holding all of those positions still. I've extended duration on my Brazilian stock holdings. They were coming up on expiration for half of the position. So I've extended duration here to 73 days because this has worked all last year and continues to work to start this one. And I am still long gold, but of two minds on the dollar. I am short the dollar against the pound and the Canadian dollar, although I'm getting a little bit antsy in the Canadian dollar version. But yesterday I flipped over my euro position, as we discussed on the show here. So I'm actually now short the euro, and that's worked pretty well today. So I'm sort of straddling the dollar from both the long and the short side, depending on which counter currency one looks at. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm also writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.